All of these things, though, have obviously had an impact on inflation. There are two numbers essentially out there. There is a core inflation number, which the governments use. That's the one which they publish. That's the one that they all want us to listen to and believe is a real inflation level. And then there's what we call a high frequency headline inflation number. That's the one that you and I are particularly interested in. Earlier on this year, we did some research. As it happened, we looked at the UK economy, and we took a basket of, I think it was 15 products, household products, included utility bills, car tax, clothes, men's, women's, children's, all that sort of thing, food, basket of 15 products. And we just simply added up their change in prices from the 31st of January 2010 to the 31st of Jan 2011. The average price across that basket of goods, the average price increase was 12.5%. Now, the headline number, which the government is talking about, is 3-4%. And so you sort of look at those two things and you think there's a bit of a mismatch here. And I know that that is exactly the same story here. Those goods that you go out and buy on a regular basis, the prices have just rocketed. But of course the government doesn't want you to focus on that number. So they still are wedded to the core number. And the reason for that is because they say that oil prices, petrol prices, and food prices are what they call transitory. They come and go during the course of the year, and therefore it's not fair to look at those as being deeply embedded within people's psyche and indeed budgets. But the risk is, of course, that those things become embedded, and the fear at the moment is that that is actually what's happening. And as I said, Walmart has already said that they expect prices to rise for clothing in particular as the year goes on, and Gap have said exactly the same thing. And that's when they become embedded, and that's when it becomes a problem for governments, because the rest of us go around and we start knocking on the door asking for wage increases. And the moment that we start asking for wage increases, the core inflation number rockets. And that is the thing which is actually taxing economists' mind at the moment, and indeed central bankers, because suddenly if the core inflation number goes up, it's very, very difficult to actually rein that back in. And the bluntest weapon which central banks have to try and rein it in is interest rates. Now, in Australia, we've already had around 5 rate increases over the last 12 to 18 months. The markets are anticipating another 3 to 4 over the next 12 months. That's fine, in as much that the Australian economy is actually pretty robust. You have products that people want, blah, blah, blah. But in Europe and the US, it's a different ball game. You have massive unemployment. I saw a figure earlier on this week that in Spain, youth unemployment, I think it was between the ages of 19 and 25, was currently running at 40%. I mean, just enormous unemployment at that end of the market. In the US, it's not dissimilar. There are several different numbers for the employment data in the US, as the official and the unofficial. There are suggestions that the unofficial number is running closer to 18% rather than the 8.5% that the government publishes. So you suddenly have governments who are trying to maintain the recovery, economic recovery which they have, which is looking a little bit subdued now. They can't possibly raise interest rates, especially with inflation, and then they have the problem of inflation rising and trying to control that. So they are between the devil and the deep blue sea at the moment. They have real issues in terms of how to balance these two things up, and time will tell exactly how they're going to play out. Naturally, they're all saying that inflation is going to moderate as the year goes on. Well, they would say that, wouldn't they? But I think certainly our view is that that is probably the case. But the reason is somewhat different. To get a continuous rise in inflation, you need to see all those different products actually continue to rise at the same rate at which they've been doing for the last 6 to 12 months. We don't believe that that's actually going to happen. And therefore it just becomes a mathematical thing. The rate of increase in inflation provided that doesn't happen, will naturally start to moderate because the like-for-like numbers will start to diminish. But that's a technical thing. That doesn't mean that it can't stay at an elevated level. One of the other myths about stock markets is that rising interest rates are negative for equity markets. At the beginning of the year, we did some research. We looked into the last 8 tightening cycles in equity markets in the US, Europe, and the UK. We went back 40 years and found 8 tightening cycles. And then what we did, we basically plotted the performance of the stock markets in the 12 months prior to that first rate increase and the 12 months after that rate increase. What we actually found was that the impact on the stock market was negligible. Indeed, as this chart shows, it actually went one way. The only country where it didn't, where you can see a little bit of a blip, which is here, was actually the US, and that lasted for a month. In fact, what happens is, provided the rate increases are gradual, they're well flagged to the market actually accommodates it very, very well. What they acknowledge is that essentially the economy is expanding, it's growing, and that's a positive. And so they move on because they think, well, that's not going to derail the economy. The risk actually is if rates go up very sharply in very quick succession. Excuse me. That is when you have a real problem. So if rates, for example, go from 1% to 2% to 3% to 5%, then it hits the fan. Provided that doesn't happen, markets will actually trend higher. So at the moment, in fact for the last 5 or 10 years, central banks, central governments, bankers have actually been pretty adept at flagging to the market when they want to move rates up and down. They manage the markets very well. And whilst rates are going to continue going up, and we believe that they will, particularly in Europe and the US, and we've seen it in Europe already, although they'll probably hold off for the moment for any future moves, they manage that news very well. And we don't think that it's necessarily going to derail the markets at all. So in summary, we actually believe this year there will be a consolidation in equity markets. Indeed, since about March, April, markets have actually been trading in a fairly narrow range. They were off last night, 1 to 1.5%, 2% in Europe, I think it was. But that still takes them only to the bottom of their recent trading range. The funny thing is, of course, that when you're in inflection or at inflection points like this, at the bottom of those trading ranges, it feels like the world's coming to an end. All the economic news, the radio, the television, the press, is full of negative news, and it just feels like it's all going to go horribly pear-shaped. And then suddenly someone pulls something out of a hat and the markets go to the top of the trading range. Suddenly all the economic news is positive and it feels like it's going to break out again. And that is very much the sort of point that we're at now. At the bottom, it just feels so bad, and at the top, it feels great. It remains to be seen what is actually going to take us out of the top or bottom of those ranges. Our feeling is that they're probably going to continue to range trade. It'll have some bad days and it'll have some good days. But until the economic picture is clearer, it is likely to stay in this range. As I've said, we're still positive on the economic outlook. We don't believe we're going into another recession. Sure, things are slowing down, but that's actually quite normal. That's exactly what you would expect to get as an economy or as economies mature after the recovery phase. We certainly have a dual speed economy in Europe, as we've already touched on. Northern European countries are actually performing very strongly. Sure, Germany is showing signs of slowing down, but it's not like the Club Med countries, some of which will not recover for 10 or 15 years. So we have a dual speed Europe. And as I said, it's probably more of a hedge in May at the moment than a sell. And certainly at GVI, we've actually been actively involved in hedging the portfolio over the last few weeks. And indeed, we've gone more defensive in our stock positioning. Having had a lot of cyclical stocks over the last few months, we've actually started to reduce those and go into more defensive sectors such as utilities, telecoms and pharmaceuticals. We've raised our cash levels up to 16-17%, and as I said, looking to hedge other parts of the portfolio as we get these rallies. So there is no doubt that at the moment we think that it's a fairly dangerous period, but we don't actually believe that the game is over.